Okay, before we head into this week's market outlook, a reminder, next Sunday I have live sessions, April 30th. This is for the Applied Series subscribers. I ran the first one at the end of last month. The last Sunday of each month is when I plan to do them, and it was well attended. I couldn't even get to all of the questions, even after I think 2.5, 3 hours. There were still so many that I couldn't answer. So I have two sessions this time. One that starts at noon. This is Eastern time, New York time or Toronto time, whichever geography you think better in. So the first one's 12 to 1:30, but I don't usually stick to the hour and a half. It can go up to 2 hours, 3 hours if there are enough questions. And the next one is at 9 p.m. in the evening. So you can either grab 12 noon Eastern time or 9 p.m. Eastern time next Sunday. This Sunday, which is where we are today, at 6 p.m. Eastern time, I have an open Q&A session on YouTube for Level 3 candidates. And I'm sure many of you have questions about the changes coming up, the new streams for Level 3. I probably only have the same information you have. Which is what CFA has provided, but I can give my opinion of what I think of these things. And if you have any other questions related to the CFA program itself, if you have questions related to the content, that's not really what I'm doing in this session. It's really about the CFA Level 3 as a whole. So that is at 6 p.m. this evening. I'm going to stick another public service announcement in here. That's the trade-off, right? I took out all of the monetization, so there's no more ads. You'll never see any more ads as you're watching through the video, but I will front-end load with stuff that promotes what I do. If you're interested in learning more foundational knowledge about finance, for many of you that are listening, the majority of you are CFA candidates or CFA charter holders, but this channel does attract more and more viewers who are neither, that may want some foundational knowledge. If you go to markmeldrum.com, over here we have the 2018, the complete level 1 from 2018, which some sections have still 80-90% overlap with the current content. Some sections not so much, maybe 15, 20, 30%. It varies per section. We're going to have a grid up soon that when you get to section, it'll give you our best assessment of what the overlap is with the current content. But there it is for free. If you're not interested in actually pursuing the CFA charter, but you'd like to get the same foundational knowledge that Level 1 provides, there it is for free. You can go ahead and just click on that. It doesn't ask you for much information. It just asks you for a name that you log in with and a password. That's it. We don't ask you to fill out 10 pages of information, and we'll never send you emails. So you can click on free content. If you're looking for CFA content, you just click here. There's FRM, there's applied courses. So if we click on CFA, it says select exam year. You just drop it down. You'll notice it's only 2023. In 23 days. Yes, 2023, in 23 days from now. It's amazing how that works out, right? May 16th, registration for Level 1 and Level 3 for February of 2024 opens. And it's early registration, so it's the cheapest price you'll pay. So if you're interested in 2024, that's in 23 days. That starts May 16th. If you're looking for 2023, I believe August deadline is May 9th. So if you are going to register for the August exam for level 1, 2, or 3, you have until May 9th to get that done. Okay, let's go. All right, before we head in, I've been asked a couple of times if I could show how to buy treasuries on Interactive Brokers, and I keep forgetting. I've explained it verbally, but I'll show you now. On the main screen, you have a whole bunch of icons across the top. You should see Treasuries. If you don't, there's this final last button over here, this arrow down. Just click on that, add more buttons, and you'll find it in the list of things that you can add. When you click on Treasuries, you'll get this interface that's open. Under Type on the side of the screen, we'll just scroll up here until we find Bills. And then we look for our maturity date. When do you want it to mature? So let's say we take 2023, and let's say it matures in June. These are the available securities that we have, and it gives you when it was issued. This one here was issued February 14th. We'll click on that. That should mature around mid-June, June 14th. Click on OK, and it shows up on your panel here in your quote screen. This is the one I have set up just for Treasuries. I'll explain it briefly. I have the Fed Funds Futures Term Structure, ZQ. Normally I wouldn't have that, but when the Fed is in any kind of mode of tightening or loosening, you want to see what the term structure looks like. For years they were on hold. Well, then it's boring because those things never change. Then I have futures, ZT for the 2 years, ZF for the 5 years, ZN for the 10 years, ZB for the 30 year. And then you can have quotes for rates directly. There's the 2 year, the 5 year, the 10 year, and the 30 year. There's our government bill. There's the bid. There's the offer. So you can choose either one. Well, if you're buying, it'll give you the, if you hover over it, it gives you the ask yield. So if you're buying on the offer. It's yielding 4.833. So if you buy this by June 14th, whatever you pay, you'll yield 4.833. And it also has a yield on the bid. That means if you place a bid and somebody sells it to you, you get a yield of 4.9454. So it just gives you the difference between the two, depending on where you buy. You can try placing orders in the middle of the spread. I've never found that to be very effective. If you're buying, you either have to hit it, buying or selling, you either have to use the bid or the offer. It shows you the depth on each side. There's 10,000 available if you're trying to sell, 5,000 available if you're trying to buy. They're in increments of 1,000. And that's it. When you open that screen for Treasuries, you can select any type of government bond. You can select the maturity you want. And if there are bonds that match what you're looking for, it will show up. Well, let's look at what happened to rates over the course of the week. Not much of a story to tell. There's only one story on this screen, and that is the 1 month rate. Look at the change. Not down 93 basis points. That's not since the beginning of the year. That is Friday over Friday. Last Friday it ended at 4.29, which I noted was rather curious that it dropped that low. Well, we're at 3.36, almost 100 basis point drop on the 1 month. That says that you have price insensitive buyers heading in there. They want this to mature well before June 15th. June 15th is the Treasury's next tax installment date. And why would you want it to mature before the 15th? On the 15th was tax deadline day in the U.S., which means Monday, the 17th, was the day to file, which means the Treasury would have gotten all of their payments for taxes due on the 18th, which this information would have probably come out sometime on the 19th, because you got to wait all day on the 18th before you can add up how much came in. It came out on the 19th, and we'll see what happened the next day. But on Monday, the 1 month dropped from 4.29. It dropped 20 basis points to close at 4.09. Tuesday dropped another 20 basis points, stand at 3.89. And then Wednesday decided to take it easy, 3.95. And then we found out that the Treasury tax day haul was $108 billion. And they now have a balance of 252, which calls into question whether or not they can even make it to June 15th for their next tax installment date. Look what happened on Thursday. 55 basis points alone on Thursday, closed at 340. Friday brings it down to 3.36. Not only that, the 5-year U.S. Treasury, the credit default swap, yes, a credit default swap on U.S. Treasuries, the 5-year U.S. Treasury, 51 basis points, 18 of that coming on Friday alone. I think it closed Thursday at 33 point something, and then Friday 51 basis points. If you look at a 5-year chart of the 5-year U.S. Treasury CDS, it's the highest it's ever been. By quite a significant margin. CDS spreads on 5-year U.S. Treasuries at 51 basis points. The 1 month sitting at 3.36 while the target range is 4.75 to 5. And never mind that, this 1 month period is a constant maturity 30-day, which means it covers the next 30 days, which has the next Fed rate hike within it. So it's really reflecting a 5 to 5.25 range because the Fed is expected to go 25 basis points, and you're at 3.36. This should be pushing up close to the 5 or even a little above the 5. So we're a good 164 basis points below really where it should be priced. So this is rather interesting. You got this going on. These are price insensitive buyers that are more concerned about the return of their capital than the return on their capital. And if you think about corporations across America, you look at their balance sheets, it's not uncommon to find cash and cash equivalents. And cash equivalents is, you don't just leave cash in a bank account, you put it in something that yields something. That's the maximization of revenue proposition. You put it in something that yields something, and it's meant to be very, very safe. It's meant to be a cash equivalent. Well, if there's risk, it's no longer a cash equivalent, which is why those short-term marketable securities are usually very short-term and very, very safe. And if it does get into anything with credit risk, it's usually investment-grade commercial paper. So it's probably saying, look, we want our money back before that June 15th date, well before that, because you're probably not going to make it to June 15th. The easiest place to get into right now is the 1 month. Look at the 2 month, 4.98. Look at the gap, 3.36 to 4.98. The problem with the 2 month is it goes past June 15th. So if it goes past June 15th, there's a question of whether or not you're even going to make it to June 15th. So I want my money back well before June 15th. You're probably not even going to make it to the next installment date. CDSs are saying that as well. And the Treasury can start implementing extraordinary measures starting June 30th. So there is some belief that that brings up what's called the X date, just the letter X, the X date, meaning when it's done, when Treasury has nothing left to pay out. It's over. It's done. They've run out of money. And this week, we've seen that there is a lot of light between the Republicans and the Democrats when it comes to how close they are on negotiations. They are miles apart at this point. And with all of this happening in the background, with the market taking these moves, I find that interesting. That'll be something to watch. Let's look at slopes. The capital market inversion, 291 days now. And the money market to capital market inversion, the more critical one, sitting at 179 days. 157 basis points. The deepest inversion for this cycle happened on April 13th at 165 basis points. And the money market to money market on the forward curve, the 3 month, 18 months from now minus the current 3 month, inverted 184 basis points versus 187 last week. Not a lot of movement. Fed balance sheet dropped 22.5, but 15.5 of that was the runoff of the balance sheet of the SOMA account. So $7 billion came out of reduced demand from banks. So we're sitting at 7.75 trillion in the SOMA. And it came from a mixture of securities. U.S. Treasuries was 2.4 billion, TIPS 11.6 billion, MBS 1.4, and just a tiny little bit, 5 million out of commercial mortgage-backed securities. And in money market funds, we have a decrease. The first time in how long that we've seen a decrease, almost 70 billion, 68.64 billion, down to 5.21 trillion for the week. Retail dropped almost 10 billion, institutional dropped almost 60 billion out. This line here is interesting as well. Among taxable money market funds, government funds decreased 60.42 billion. This is coming out of money market, which is anything in this direction, including what you have down here. So money was leaving that. So you have to start thinking about how much more was entering to overcome what was leaving and still push the 1 month down to 3.36. FOMC meeting May 3rd is now 10 days away. In 5 days, we get two big reports. Q1 GDP, the advanced look at GDP. This is our first look at Q1 GDP. Get that in 5 days. GDP now is sitting at 2.5. That's the Atlanta Fed's now casting for GDP. There is no Fed speak. They're in the quiet period, so we're not going to get anything this week. ECI, the Employment Cost Index, the true measure of wage inflation, or the cleanest measure of wage inflation in 5 days. Same time that Q1 GDP comes out, we get ECI as well. The odds of a 25 basis point hike have increased to 89.1%. Zero is down to 10.9%. Looking into June, more weight is moving to the 5.5 as the terminal rate here. 5 meaning no rate hikes have dropped from 13.9 over the two meeting periods down to 8%. The one rate hike has gone from 72 down to 68, and two rate hikes from 13 up to 23%. Almost 25% probability of two rate hikes in a row. Effective federal funds rate still sitting at 4.83. The reverse repo still in demand, up 36 billion over the course of the week. We're going to look at the Beige Book here shortly. That was out on Wednesday. It's kind of interesting, although repetitive, but it is interesting to look at the overall summary and each of the federal districts. But overall, mostly unchanged. Terrible color there. Mostly unchanged. Lower prices and easing labor market seem to be the kind of the themes that we get on the summary, but we'll look at it shortly. I've added some China data here because China was a bit of a story for the week. Their Q1 GDP came in at 4.5%. This is year over year, which isn't shocking when you figure that last year in Q1 there was just a lot of lockdowns. The estimate was 4%, came in at 4.5. The previous was 2.9. Quarter over quarter, though, not as impressive. The estimate was 2.2, came in at 2.2. The previous was 0.6. But, I mean, it is reflecting a quarter of being completely open. Industrial production came in at 3.9. The estimate was 4. Previous was 2.4 as year over year. This is the big one here, retail sales. Previous was 3.5. This is year over year as well. And the estimate was 7.4, came in at 10.6. So the GDP data actually did create some excitement in metals markets, not so much in copper, which I found really odd, that copper really just wasn't responding very well. But the platinum and palladium, both of them jumped like 10%, quite significantly on the data, but copper simply didn't follow along, which I thought was just a little odd, but okay. Canada CPI came in at 0.6, the core 0.6, the estimate was 0.4, that came in hotter than expected. Retail sales negative 0.7, the estimate was negative 0.6. This is ex-autos, take cars out of there just to get a measure of consumer spending without the big ticket item. This is month over month. The Canadian dollar weakened quite significantly from 1.33, I think it was about 1.335, 1.336, all the way to 1.355. So the U.S. dollar strengthened almost 1.3% against the Canadian, with the yen and the peso pretty much unchanged week over week. The Canadian is dropping. I am now taking a long position, starting to build a long position in the Canadian. I really would like to see it get to 136.5 to the 138 range in there. Then I'll take a longer Canadian position on that. I haven't been able to figure out what side of the Canadian I want to be on this year, because it just sort of defies the regular logic that I'm used to. So I think I just have to think about the opposite of what I would want to do. So I will trade it Costanza style. All right, this was released Wednesday, April 19th, the Beige Book. And it's, other than the summary, it gets really repetitive, but there are some interesting things in each of the districts. This is kind of nice if you want a nice high-level overview of the Federal Reserve districts. It gives you all 12 of them and color codes them for the areas that they cover. There's San Francisco, big geography there. Minneapolis, big geography, but you got the Dakotas in there, you got Minnesota. I think the total population of all of these people is like 137. I think there's like 14 people in the 2 Dakotas. I don't know anybody who lives there. It's a pretty empty state, but they get 4 senators. Isn't that great? Anyways, here are the 12 districts. Let's go down to the beginning here, national summary. So they give an overall economic summary, and the theme is one big yawn. Just, whatever, nothing changed. Overall economic activity was little changed in recent weeks. 9 districts reported either no change or only a slight change, while 3 indicated modest growth. Expectations for future growth were mostly unchanged as well. However, 2 districts saw outlooks deteriorate. And it goes on to a little bit more. Labor market employment growth moderated somewhat this period as several districts reported a slower pace of growth. Overall prices rose moderately during this reporting period, so you still have inflation, though the rate of price increases appeared to be slowing, which is disinflation. Contacts noticed modest to sharp declines in the prices of non-labor inputs and significantly lower freight costs in recent weeks. Well, that's all good for the inflation story. And then it just goes into a little synopsis on each of them. And then it goes into detail, a 2-page on each of the 12 districts. This you'll find interesting. They talk about commercial real estate and residential real estate in each of the sectors. Commercial real estate activity in the 1st district was mostly unchanged since February. In the industrial property market, rents continued to level off, even though leasing demand was still deemed strong relative to supply. Office leasing activity was mostly flat, although contacts noticed a modest slowing of deal flow in both Boston and Providence. Office asking rents were roughly stable, but one contact noted that tenants demanded and on balance received increasingly generous concessions. Conditions in retail market worsened slightly. You'll find that a theme, that in each of the districts when they talk about the retail market, that it seemed to just be getting worse in each of the districts, but it's been known for quite some time that there's way too much retail space in the US. I was at the mall just the other day, and as you're walking down the mall, I think I counted like over 20 clothing stores, all directed towards this fast fashion stuff. And I thought, well, would anyone notice if these went down to like 14 stores? Would anyone even notice if it dropped to 14? You can get rid of 1/3 of all of these clothing stores, and I don't think any consumer would have less choice. It's all the same stuff, just in different stores. And they talk about residential real estate. 1st district home sales softened in February following a temporary uptick in sales in January. I'll leave that for you to read. Here is New York. There's residential rental markets, commercial real estate as well. When you get into Philadelphia, there's real estate and construction, market participants in commercial real estate. And they have that in every sector. There's real estate and construction again. Non-residential construction, real estate. So if you're interested in a particular, either the labor markets or for prices or consumer spending, and you just want to read that one category across the 12 just to get an idea of what each of the central banks are seeing, the Beige Book does that for you. It's called the Beige Book because when it was originally printed, it had a beige folder. Isn't that clever? What do we call it? I don't know. It's the Beige. Hand me the book. Which book? The Beige Book. Hey, that's a good title. All real rates rose during the week. You still have an inversion from the 5-year to the 10-year. It hasn't really changed much. 4, 5, 6, 7 basis point inversion. Very mild inversion. But they are, real rates are going up, which is usually negative for equities, and we see that SPY almost unchanged on the week, negative 0.06. Break-even rates pretty much unchanged, 1 or 2 basis point movement. Not much excitement there. I don't think there was much interpretation on what to do with expected inflation over the week based on data we got. For the Fed funds rate, this curve is going to have to flatten. If we continue to get economic data that suggests that the economy is handling higher rates, there doesn't seem to be any issue in the job market. Companies are reporting Q1 revenues kind of mixed. Some are missing, some are beating, some are lowering guidance, some are raising guidance. It's really mixed. But if we continue to live here, from a Fed perspective, it's, well, what do you need lower rates for? You guys are doing just fine. Unemployment of 3.5%, you don't need lower rates. Inflation is coming down, so okay, maybe you don't need higher rates. But that doesn't mean we're cutting, right? So I think that this curve is going to have to start flattening out. This end is going to have to come down, but I would not be making that bet, because exogenous events, geopolitical risks happen all the time, and credit events happen out of nowhere. If you see, if a credit event is expected, things get put into place to help prevent that from happening. It's when something happens that's completely unexpected, I don't want to be standing in the way of that. That's the bigger risk right now. I think that curve has to flatten, but I am not making a bet on that curve flattening. I'm not making a bet on it steepening either, because I believe it has to flatten. But I don't want to wake up one morning and find out that something happened in the middle of the night and I'm dead in the water because I'm on the wrong side of that trade. So I'm just saying I think it's going to do that, but I'm not putting any money at risk in that one at all. I'm just saying I forecast that if we continue with the economy as it is and inflation coming down as it is, that curve has to flatten at those lower levels. Last week, bottoming out at July at 94.94, which is 5.06 implied. It's 5 basis points higher, still at July, but now 5.11. December has increased by 10.5 basis points. Last week, the implied rate was 4.565 in December. Now it's 4.67. So it has come down, and maybe that's what it takes, is every week it's going to drop by 10 basis points, and slowly the long end of this curve will flatten out. Going all the way out to March, we see it continuing there too. Last week, the implied rate was 4.19. Now it's 4.305. So it is flattening out. From July, this is still a problem here. From July to December, the market is pricing it out by 44 basis points. Last week was 49.5 basis points. So if it has to march down by 5 basis points a week, it is going in the right direction. And this could be just a weighted average of a flat curve along with what a curve would like in a recession. And you have some probability on the recession, some probability on the flat curve, and this December rate could just represent a weighting, a weight on this, weight on two, a weighting of what they think a recessionary scenario and a non-recessionary scenario, rates higher for longer, or we broke something, we got to lower rates. And as each week passes and the recession scenario gets less and less weight, and the higher for longer scenario gets more and more weight, then this curve will start flattening out over time. December 2024 over December 2023, using 1 month SOFR, 3.14 versus 4.48. And you have to pretty much use the SOFR rate here, because you can't use that 1 month Treasury anymore. Negative 134 basis points. And this is the progression over the last few weeks: 132, 134, 130. SVB happened, 97, and then this was before SVB. SVB happened, went to 197, 130. Sitting at 134, basically unchanged over the last 3 weeks. This will have to start coming down as well, less negative, 134 to 125 to 110 to 90. It's going to have to flatten out for a period of time, because they are talking about 2025 before they get back to their 2% target, Whether they'll start lowering rates before that is a question, but if the economy is doing what it's doing and you have 3%, 3.5% unemployment over that period of time, there is no reason to lower rates. Why? Full employment? Check. Price stability? Check. There's your neutral rate. There's your new neutral rate. Get used to it, right? TLT dropped 0.65% over the week. SPY, little changed. Still, no volatility, no implied volatility in TLT. And I'm going to talk about zero data expiration options and the effect that they may be having on volatility. And, you know, if we might be able to accept that at the index level for SPY. But there are many stocks as well that are at the zero line in terms of implied volatility, all at zero. So that don't have zero data expiration options. So they don't have them. I don't see much change in the volume of the options for those particular names, and they're sitting at the zero line as well in terms of their implied volatility. I sold 10 more May 104 puts at 215 because it had some nice premium in there, and I thought, well, why not? I got 100, let's get 110. I am going to add the March 24 105 calls. They're sitting at 765 right now. I'm looking to add 50 of those. I've got 60 of the January 2024 110 calls. I'd add 50 here. We'll see what happens at the beginning of the week. And we'll see what happens to TLT. But if I see much weakness under 104, it did get down here midweek to 103.50. If I see it get there again and these premiums drop down to, I can't expect implied volatility to leave. Like, I can't look for lower premiums because I'm going to get low. Well, you know what? We're at zero. Last implied volatility is 15.4. Maybe it's the lowest it's ever been, but that doesn't mean it can't go from 15.4 to 14. Maybe I can get some premium disappearing with, even lower implied volatility, which I don't know. Maybe it's reasonable, maybe it's not. But I am going to try to add 50 of the March 105 calls. And then I will slowly begin to work those off because I'm in a no-lose situation right now. No matter what I do, I can't lose on this particular trade. So I may as well take some of the guaranteed income I'm going to get and simply just buy more calls and put myself in the worst case position would be I don't make anything and I don't lose anything, zero. So I may as well buy more of these calls. The OAS showing little change over the week. Triple C has become less risky. The US 5-year Treasury has become more risky. And the Triple C, the riskiest of credit, has become less risky. I wonder if these markets talk to each other. I've always been curious about that in Canada when you go to one government office and you say, well, don't you have that information? So, our system's not connected to this system. The systems don't talk to each other. I wonder if that's the same thing in the bond market where the riskiness of treasuries just don't talk to the riskiness of triple C credit. Like, these two markets are so distinct, these people don't even talk to each other. Because it's like saying, oh my God, I'm afraid of the risk in the 5-year US Treasury. Well, I'm not really afraid of the risk in the riskiest risk, though. I don't think they talk to each other. 1-year US Treasury is 4.78 versus 5.24 on the 1 to 3 year investment grade bucket, so 46 basis points. Now think about this a minute. 46 basis points to go from Treasuries to investment grade, but 5-year CDSs want 51 basis points. High yield. For April, month to date to April 20th, high yield bond issuance over 14 billion, which is 9% over all of April 2022, and there's still 6 more issue days to go. That is the Thursday. So you've got 5 days this week plus the Friday that you can add to that. You got 6 more days to go, and you're already 9% over last year for high yield issuance. Last week there was a new issue brought to market every single day. And just to put a pin in the willingness to accept risk AT1 bonds. These were the ones that were wiped out in Credit Suisse's bankruptcy. They're called COCO bonds or contingent convertible. Either they convert to equity or they're written down to zero. It'll be in the prospectus which of the two outcomes it will be. Sumitomo Mitsui. I guess Sumitomo Mitsui. There we go. Financial Group, SMFG, issued in US dollars 1.04 billion or 140 billion yen in AT1 bonds, and they were scooped up in 5 and 10 years. The 5 years yielding 1.879, the 10 years yielding 2.18. Just what is that, 3 weeks after Credit Suisse, where those AT1 bonds were written down to zero. There is a first issuance since then, and it was all taken up. High yield, greater than 14 billion month to date, 9% over last year. Triple C, less risky. And again, let me revisit the 5-year US Treasury credit default swaps, never been wider. Okay, let's get to housing, where I am quite upset over this past week. If you saw DHI's earnings and the price reaction, I hated myself every minute of the day looking at it. I didn't get more aggressive selling the puts. I really thought that I would have an opportunity in the low 90s to sell more puts, and no. The market knows I want in. 6.39, up 12 basis points Thursday over Thursday. The U.S. Treasury for the Thursday over Thursday was up 5, and this was up 12, which means the spread increased by 7. Agency was up 0.9, annually up 0.78, and ABR up 3.58% week over week. I'm reminded of the person who said, somebody said I should sell it, so I sold it. And I said, well, if that's what you think you got to do. And last week I talked about not outsourcing your thinking. So the worst thing there is, because I've been in that situation, is where something is losing and you say, you know what, I give up. You sell it, and then a week later you see it's up 3, 4, 5%, and you just hate yourself for it because it's like, oh, come on, man. Mortgage apps down 8.8%. Refis down 5.8%. Purchases down 10%. Doesn't affect home builders. Look at the week they had. DHI up 8.48%. Lennar almost 6%. Pulte 4.47%. They have earnings this week. I think I'm going to buy some more of this before their earnings, or sell some slightly in the money puts before their earnings. I can't see how they're going to miss. It's just such a beautiful environment for the home builders right now. Toll Brothers up 3.03%, KB Homes up 5%, Hovnanian up 10%. The index, the home builder ETF here, not the index, the XHB up 3.41%. Absolutely on fire for a market that was basically flat week over week. Look at the numbers these things return. Yes, I have some DHI, but nowhere near the quantity I really wanted to get, and it did not give me an opportunity to sell any puts in the low 90s. So now I'm really hoping for something really bad to happen for no other reason than to let me back in the low 90s. I want everyone to suffer so that I can benefit at least a little, right? That's selfishness. NEHB for April came in at 45. The previous was 44. So yes, it's still in contraction, but not as much in contraction, which means it is coming off the bottom of its contraction. Building permits for March down 8.8%, but you had such a big pull forward in February with all of the nice weather. A lot of permits were taken out then. Same with housing starts. A lot of housings were started at the point in time. So this is just reflecting the fact that what would have happened in March just happened the month before. I'm not reading too much into that. Canada housing starts for March came in at 214. Previous was 241. The forecast was 237. This is not going to help housing prices. And what happened in March in Canada? Housing prices ticked up. They ticked up. And same with the U.S. Look at this down here from Zillow.com. Home price growth accelerated in March. Home price growth accelerated as competition heated up over record low new listings. Record low new listings. You can't design a better environment for home builders at this point in time. What do we got left? Existing home sales for March down 2.4%. Previous was 13.8%. So much happened in February because you had such a easy winter to get through that it pulled forward some of the things that you'd normally get later, like in March. Tuesday we get the home price index, Case-Shiller, and new home sales. And Thursday you get pending home sales. Let's have a look at what's on Zillow, because they have a story for both home price and rent in different cities. Okay, there's the headline that I had on the previous screen. Relatively high rates are keeping new listings low, frustrating willing buyers. And if you click on this link over here, related post, rents climb modestly in March, continuing a soft landing from 2022's record-breaking pace of growth. The idea that rents are dropping in price just doesn't seem to be the case. They're maintaining their high record levels. They're just not increasing at the rate they were increasing at last year, but they're not decreasing. And then there's a lot of interesting things to get through here. So you can see where February was 332.054, and if you move it over, you get to March. March is 334. So you went from 332, the home value index, up to 334.944. Just scroll down here to the very bottom, and this is the home value index, and it tells you, what is up, and you just scroll down here and what happens to be down, where they're up and where they're down. Click on this one. Come on. This is the observed rent index, where it's up and where it's down. So Cincinnati, you move into Cincinnati, oof. Boston, Louisville, Indianapolis, up 9.2, up 8.7, up 8.3. And then you can just scroll down and see where it turns negative. Las Vegas, everyone's leaving Las Vegas. Wasn't that a movie, Leaving Las Vegas? Inventory, where inventory is up, this is year over year, and where inventory is down. And you can change month over month as well and see where inventory is up or down. New listings, new pending listings, lots to play around with here. And then you click on this, rents climb modestly in March, continuing a soft landing from the record-breaking pace of growth. And you can see here's where it grew, and you're sitting at 1966. The month before, if we can get it to click on the month before, December, March. So all we have is December. Typical rent 1982, and typical rent now 1996. This gives you year-over-year growth. So the growth is coming down, but still 6%, right? And this gives you month-over-month. It has been increasing November, January, February, March. So, they oscillate. Doesn't just go in one line. So there's a lot of good stuff here to spend some time with if you're interested. I'm not going to go through all of this stuff. It's the link for this particular landing page is with all other links in the description box. All right. I'm sure you are aware that Tesla reported earnings last week, and their stock price took a tank on that one, took a big dump. Tuesday is GM, and I added quite a few GM shares ahead of that because they're sitting around in the 33s. If they were sitting around 41, 42, I don't think I would have added, but on the 33s in this range, I added, and I'll probably add more. Let's have a look at Tesla, and at the bottom of the screen, last year, I don't know what month it was like almost a year ago, I had put out a video saying the ice age is far from over, and at the very last screen I gave a sort of an optimistic scenario for Tesla. Here is 2023 right across here. So this is all 2023 forecast, more of a very top-down forecast. And it's for the whole year. So you divide gross profit by 4, you divide net income by 4. If you divide gross profit by 4, the 4 quarters, I just even it out over the 4 quarters, I get 4.875 billion. Tesla reported 4.5 billion. I said that gross margins would come in 20% for the year. Gross margins are 19.3% for the year. Net income of 11.7, if you divide that by 4, is 2.925 billion, 2.931, which is fairly close. I gave them a net income margin of 12%. They are at 12.56% on this number. This is the non-GAAP, which is the one I'm using. I'm not going to use GAAP because you don't really forecast all of the, a whole bunch of issues that are pretty much unforecastable. So you'll just forecast non-GAAP, or what are operating earnings. Net income margin 12, yeah, and they're sitting at 12.56. Their operating margin's 11.4. They are under their 20%, and they are under their 50% growth, which was the point I was making in this video, is that they'll continue, I think, to have industry-leading margins, but they're not going to keep their 31% margin. If we look at where they were in Q1, this is the 29.1. That is without the credits, 29.1% margin, and a fall, almost 1,000 basis points over that period of time. There it is right there, 977 basis points down. A lot of negative signs here, eh? A lot of negative signs here. As competition heats up, you're going to have to get more aggressive on pricing. That was the point I was making, is that with everybody entering the industry, you don't get to keep those margins. And this is not a dig at Tesla at all. It is just the history of all competitive markets. It is just the structure of every industry that comes under competitive pressure is all margins get squeezed. So if you are making abnormal profits, and an abnormal profit, remember, is when you're making economic profits greater than zero. And economic profits are accounting profits less your cost of equity. Once you take out the cost of equity, everything else is an economic profit because you've totally paid for your cost of capital. And those are called abnormal profits. Some companies can keep abnormal profits if they can distinguish themselves from other players, but vehicles, especially once you get into the electric space, you have your brand names, but they are substitute products, almost perfect substitute products across different brands. You don't get to keep those margins. So this, I'm not saying look how good I was at doing this. It was just look how powerful the history of economics can be. Is that if you understand how industries evolve over time, you would have seen this coming too. I think any second-year economics major would have said the same thing, that wait a minute, you have a company that's alone in an industry and everybody is entering that same industry. What's going to happen to their gross margins? I think if you put that on any second-year economics exam, I think every student would have said those margins are going to contract, and they did, 19.3. Now, mind you, this is for the whole year. This is simply just Q1 2023. But if you divide mine by 4, it's pretty much right on target for each and every one of these. That implies a year-end target for 2023 of $113. This was pretty much hit as well. My 2022 targets were pretty much hit as well. I said 24% gross margins. They ended the last quarter at 23.8 on gross margins. And I said 418. This is pre-split, so you divide that by 3, you get to 139, and they ended last year below 139. And then, of course, they had almost 100% bounce up to the $200 range, and now they're coming back down. But by year end, 113. If competition, unless everybody in the EV space right now says, you know what, leave it to Tesla, we don't want it, we're not interested in this space, then this pressure will continue. Tesla is not number one in Europe, and I think Stellantis has better margins, better operating margins right now than Tesla. They're not number one in China. In fact, I think GM's partnership in China actually sells more electric vehicles than Tesla does. Tesla's number one. I think the only place it's number one is North America right now. Now, I'm not knocking Tesla. I think they've done incredible things. I do think they're a fantastic company. What I am knocking is the valuation and the belief that they can keep that valuation in the face of an onslaught of competition. By the way, I don't know if you saw Kathy Wood's new price target, $6 trillion on Tesla. I think it was by 2027. In 4 years, there'll be $6 trillion. Their pessimistic scenario for 2027 included huge volume from robotaxi revenue. Like, just that's pessimistic now. Is that they'll not only will they have full self-driving, but they'll have a big enough fleet of robotaxis deployed across the world that are generating. I forget what the number was, but it was a ridiculous number. Her pessimistic scenario is that, yeah, full self-driving is right around the corner, it's going to happen, and robotaxis will be rolled out in the next 4 years with enough speed and volume to be significant, and we're looking at a $6 trillion market cap. 10 million cars a year by 2027 over the next 4 years, 10 million cars. I mean, I can see that you can like something, but to just never give up with the wild, outlandish calls. 6 trillion. Your 3 trillion failed, so let's double down and put it to 6 trillion. Maybe they're consulting with Trump, the king of doubling down. All right, let's get right to S&P. I'm still using the 4-quarter earnings estimate from the April 6th spreadsheet, 224.40. If you're wondering where that spreadsheet is, I was wondering the same thing, so I emailed Howard Silverblatt and I said, hey, dude. No, I didn't say that. I was very polite and just sort of asked and hinted at the spreadsheet. He's on vacation. He said, I'm on vacation. I'll be back on the 26th. I'll update it for the end of the month. Okay, good. Thank you for your service. So it'll be updated. The next week, we will have an updated number from our friend. But for now, we're going to continue to use those numbers, 224.40. Closing SPX, 41.33, puts a 18.42, the forward multiple. The inverse is 5.43, the inverse of the PE. The 10-year is 3.57, which is 186 basis points premium over the 10-year. 6 months sitting at 5.07, so there's only 36 basis point premium over a 6 month. Implied volatility, just a touch of it came back in, right, sitting at 3%. If we look at the SPY 20-day straddle, which is just a nice way that I use to look at across different securities, which ones sort of are yielding the best, 3.03% on the 20-day short straddle over the price. GM sitting at 8.7, FCX sitting at 7.19, and they're sitting on the zero line as well. GM on the 13-day implied volatility is in the 64th percentile, so nice premium, 8.7%. Sitting in the mid-33s at the lower end of their trading range over the last year. I don't mind adding anything below 35. I've said before I don't mind adding. So I sold some puts, some 35, some 34, some 33s, and I bought a bunch of shares as well because they have earnings on Tuesday, and I'll hold them through earnings. SPY's last IV, 14.1, just continues to drop. The 4170 puts, let me explain what I'm doing there. There's no volatility. I don't want to sell anything, any more calls on my ES position because I already have a fairly decent negative short position. Negative short. Well, yeah, I am net negative short because I do have some sold puts in there as well. So with the 4170 puts, I'm taking advantage of the intraday volatility. If you watch the 0 day, the day that you happen to be on. Now, I'm not using a 0 day to expiration 4170 put. I'm using the June expiration with the September underlying, but I am watching the volume on the 0 day. And there's so much volume you can, if you're just watching the screen, you could see where the volume happens to be going. And you trade in the opposite direction of it because the market maker has to take the opposite side of the trade. So when the market drops, I sell the 4170s in the range of 96 to 102. When the market rallies, I buy them back in the range of 87 to 91. And over the course of last week, I was able to get that done, 2, sometimes 3 times a day, again and again, just playing that. Now, I'm not going to be selling any calls, so when the market rallies, I don't want to sell any more calls. When it sells off, when I sell the 4170 puts, I'm comfortable with that because I have sold some 4,000 calls. And my average price on the 4,000 calls is 176, which puts me to 4176 on a break even. So if I sell 4170 puts, let's say in the middle at 100, that then brings me to a 4276 break even if the market continues to go up. If the market drops, well, I do have some downside risk on that, but I would be earning the 176 on the calls. So I'm happy day trading the 4170 puts for June expiration with the September underlying. So it's the regular June expiration, the third Friday in June, but not the June underlying, the September underlying. I'm day trading that by watching the 0 day to expiration volume. I'm just watching the volume, and if you see the volume load up on the puts, the market maker has to take the opposite side of that trade. Because, well, they got to hedge everything out, right? What did I add this week? Alcoa after earnings. I added more ABR. I added GM, and I'm looking for the June puts, the 54 days to expiration. I'm looking to sell BHP $50 puts, Rio $60 puts, and FCX $37 puts. I don't know when I'm going to do it. Those are the strikes I'm looking at. And I will wait for price action to tell me what to do. If I see weakness in these 3 names pushing down towards those strikes, I will sell puts at those particular strikes. I'm not rushing to do it, but being that it had a week of pullback, I am looking to add on any more weakness. Let's have a look at earnings for next week, because there's a lot of them, and then we'll look at the economic calendar, and then off we go. A word of warning here about what I'm doing. Don't try to copy me. If you don't know how to do this, if you're not comfortable doing this, if you don't already have a position that if you're wrong, you end up just being hedged. So in other words, I have a short position. By doing this, it makes me less short, which sort of hedges my upside risk by being less short. So the worst case scenario is I end up with a less short position. Best case scenario is I make money. Unless you're already structured such that heads you win, tails you win, don't do this trade. I can't lose on this trade. I can only win. The only way I would lose is if I sold the puts and the market really, really dropped. But then at that point, I'd be looking to get long anyway. So I really can't lose on this. I've got myself in a position because of the way I'm structured that I can't lose. So don't start day trading the 4170 puts based on the market going up and down, because there's no reason why intraday volatility need just be bouncing back and forth like it did last week. It may just continue straight down and you'll get hurt unless you have something that offsets that on the other side that you're looking to offset anyways. Do you get what I'm saying? That in the worst case scenario, I end up pretty good. In the best case scenario, I end up pretty good. When you have a decision tree where, no matter which way you go, you end up pretty good, it's a no-brainer not to do it. Don't copy me unless you have the same kind of outcome where heads you win, tails you win. All right, so here are the earnings for the week coming up. And what I did, I went to the forward schedule. I just copied all of those that were reporting this week, and I put them in a different sheet so that I could highlight this column here. So you can read it in terms of Monday, Tuesday, Wednesday, see who's reporting, but I prefer to look at it by what sector happens to be reporting. So we can take the sector, or we can take the final one. If you take the final one, I'll show you what you can do. Take the sort here and sort A to Z. expand the selection, sort, there you go, advertising. So now it's broken down into the industry that you may be interested in. And since it's alphabetical, we can just go to what we're interested in down the side. So home building, there we are. We have NVR and Pulte, which are reporting on Tuesday, and the ATC is after the close, so we know it's Tuesday morning. We can move up here to automobile manufacturers, and we can see there's only one, it's General Motors, and it's Tuesday before the market opens. So since I'm going to add more Pulte, I'll have two earnings reports on Tuesday morning, and it gives you a better idea, depending on what it is that you want to keep your eye on. That you could just look straight down the side. If we're looking for, let's see, regional banks, there are none. So that's all over with, right? But we do have in financials, we do have a whole bunch of insurance companies as well that are reporting. So there you go. That's a nice sort of way to just look at everything in your particular sector that happens to reporting, because you may have, a particular company, and a different company in your sector is reporting. Its results will affect your company, even though it's not your company reporting. So you do have reporting risk with your peer group. Anyone in your peer group reporting will affect your holding as well. So it is worth being aware of who in your peer group is reporting. Okay, a lot going on this week on the economic calendar, plus an opportunity to correct a mistake I made earlier. I said that GDP for the U.S. for Q1 and ECI were due in 5 days, both of them on Friday morning. I'm wrong on that one. GDP is due on Thursday morning. ECI is due on Friday morning, along with, and I can't believe I missed this, PCE report, the Fed's favorite measure of inflation. PCE on Friday, that's a big one, and I completely missed that one as I was going through the calendar. That is Friday. But we get to correct it here. Monday, 8:30 in Canada, new housing price index. And at 8:30 in the U.S., you get the Chicago Fed National Activity Index. Last reading was negative 0.19. Dallas Fed is split over 2 days. You get the manufacturing index on Monday. And then on Tuesday, if we scroll down here, you'll get the services. Along with Richmond Fed manufacturing and services. One is at 10, one's at 10:30. We get building permits, the final look at building permits for March at 8:30. 9 o'clock, you get housing price index. The Case-Shiller home price index is here. Consumer confidence at 10, along with new home sales. Going into Wednesday, you always have mortgage apps, 7 o'clock Wednesday morning. Durable goods at 8:30. And if you're into the oil market, you get inventories at 10:30 on both oil and gasoline inventory reports. Thursday, you get natural gas inventory reports. 1:30 on Wednesday, the summary of deliberations from Bank of Canada, which is equivalent to the minutes of the last meeting. And we get into Thursday. There you go. GDP growth rate, advanced look at Q1. Forecast is 2%. The previous was 2.6, and GDP now is 2.5. Governor Waller says this is extremely strong GDP. There's no need for us to cut rates. So if this comes in strong, you get 2.5, 2.6, 2.7. I think you'll see that forward curve for the 1 month SOFR rate, the 3 month SOFR rate, and the Fed funds futures curves flatten out. They would have to, because, hey, if you got rates this high and economic activity is doing this well, then we're at a neutral rate. There's no reason to raise or lower rates if that's the case. And you get initial jobless claims. That seems to be a big number to look at each week. It's becoming more and more important. Pending home sales at 10 o'clock. There's your natural gas stock change at 10:30 on Thursday. And you get the Kansas City manufacturing index. So we get 3 regions this week. Canada, we get GDP, a lockup on February, and a preliminary look for March. That may or may not move the currency. Who knows anymore with the Canadian dollar. And US, there it is right there, the core PCE price index year over year for March. I expect it to follow in line with CPI, lower than CPI, but falling in line with CPI. I don't expect much difference there. Here's the important one for labor is the employment cost index, the ECI. You get benefits and wages, but this is the index. No, sorry, where is it? Employment cost. I know it has its own index. Anyways, there is an ECI for everything, and then one for benefits, one for wages, and personal income and personal spending. Then at 10 o'clock, you get Michigan consumer sentiment. And that is your calendar for the week.